All right. Good afternoon, everyone. Welcome to this Zoom meeting where we're going to be discussing steps to trading. So just allow me to share today. I'm just going to do a PowerPoint presentation. So allow me just to share the presentation, and then we can get right to it. Okay. Right. So what we're going to cover today, just to get into the presentation, right? So what I hope this meeting is going to be a call to action to everyone here, so that after this presentation and everything that we're going to be discussing, we'll begin to see action actually happening on the ground. So that's what I'm doing. So we're going to start by learning the key steps to trading, which I believe are very important. Some people here have indicated that they're new to trading. So we're going to cover some of the basic things, which I believe are very important for new traders. We also going to cover how you open a demo account with a broker. I think that's one of the key things that we're going to cover as well. Then from there, my challenge to you afterwards is then that you need to start demo trading within 24 hours. So that's essentially what we're going to be covering today. Right. So let's get right to it. Right. I'm just going to give a brief overview for the benefit of those that are new to trading. Right. Patricia, is that a hand? Oh, I see your hand is raised up. Or maybe that's by mistake. But I'll give everyone an opportunity to ask questions as we progress with the presentation. Right. Just a bit overview in terms of Forex trading. Right. So in terms of the trading bigger picture, I think it's important for you to appreciate that when you talk about trading, it's an industry that's much bigger than just Forex. Forex is not the only instrument that you can trade. So it's you learning Forex trading, it's going to be foundational because you can then decide what instruments you can trade. So you'll see when I'll be demonstrating on a platform that you can actually trade stocks in major, for example, stocks. You can trade stocks in the US, your Amazon, your Google, your Apple shares. You can actually trade them. You can also trade indices. Some of you are familiar with Dow Jones, S&P 500. You can trade commodities. You can trade metals. You can trade cryptocurrency. So the foundation that is to teach you trading, the foundation is basically the same. So if you understand Forex trading, for example, and you can trade Forex, the switch to other instruments becomes much easy because the foundation is essentially the same. So when you talk about trading, it's a much bigger industry than just Forex trading. So it's important for us to appreciate that. Then in terms of what drives Forex trading is essentially driven by international trade as well as international travel. Different countries obviously use different currencies. If you go to the US, you're going to see the US dollar. If you go to Europe, you're going to see the euro. You go to UK, you're going to see the pound. So depending on the different countries that you are going to, those countries will be using different currencies. So that obviously brings the need for Forex trading. And that's exactly what drives that particular industry. So I'm also going to cover who are some of the major players later on in terms of the Forex market. But I just want to make a distinction between trading and investing. When you talk about trading and investing, essentially, for example, like I said earlier, I buy a lot of stocks on the Zimbabwe Stock Exchange. So when I invest in stocks on the Zimbabwe Stock Exchange, I become the owner of that particular stock. So those shares are now in my name. So what I'm looking for those particular shares is that over time, the value is going to go up. So when you're investing, whether it's gold, whether it's whatever asset you're investing in, you take ownership of the underlying asset that you're investing in. So traditionally, we have been exposed to investing. You can invest in real estate. So you buy your property and it becomes yours. You buy shares, it's the same process. Trading is a bit different because with trading, you are not interested in taking delivery of the underlying asset. So trading is normally driven by what we call CFDs, which is contract for difference. So you want to benefit from, for example, an increase in the share price. I was talking about that you can actually trade stocks in the US. So you are not really buying the share itself, but it's a contract on the movement of the share price. So what you do is, for example, if I'm going to buy today, if I'm going to start trading, let's say Google shares, and they're $100 when I enter the contract. If when I exit the contract, the share price has gone up to 150, I don't own the shares, but I take the profit, which is the difference in the movement. So trading, it's all about benefiting from the movement in the value of the underlying asset. So that's the major difference that you'll begin to see between trading and investing. And it's important that you appreciate that. Now, the Forex trading is the biggest market globally. It's bigger than the stock market. It's bigger than other markets that people trade in. On average, daily, you've got turnover of around 7 trillion in terms of foreign currency. So that becomes the biggest. Market that you can trade in. So it's a very liquid market where whenever you enter a trade, you see when you're demonstrating that it takes milliseconds for your trade to be made. So that becomes the biggest advantage with Forex trading. So who are the main players in the Forex market? The main players, so you've got a number of people that globally play within the Forex market. The biggest group being what we call market makers. These are big international banks. For example, the Deutsche Bank, which is the biggest bank globally, from Germany. You've got UBS, you've got Citigroups. So these banks command the big market share and they move the Forex volumes, right? So they're called market makers because they've got ability to influence the rate because of the volume that they push in foreign currency. But because they're regulated, obviously they cannot manipulate the rate. But by just moving the volume they can have a huge impact in terms of that particular currency. Then you've got multinationals, which are big importing and exporting companies, which have got operations globally. There's obviously they would demand foreign currency or they've got supply of foreign currency, so they become major players in the Forex market. Then you've got central banks. Central banks obviously wants to see their own currency stable, just like here we've got our own central bank. We want to see that. So our visit wants the ZW to be stable. So it's the same with other countries. You go to Japan. They always want to protect their exports, so they want their currency to be stable. All right, so they become another big player in the Forex market. Then you've got other banks, investment firms, and brokers. So starting particularly in this particular group, we see a lot of, especially this group here, that's where a lot of speculation starts. So you've got dealing desks within banks, you've got investment firms, and you've got brokers. Some of you are familiar with what they call hedge funds in the US. So these are now mostly, that's where trading really happens within this particular group. And these are quite big and they move a lot of volume in terms of their trading. They've invested in tools that helps their traders. So they'll have, pools of traders who work for them. So you see a lot of trading within these institutions, and they command a big share of the market. Then the last group is what we call retail traders. So these are essentially like people like you and me. We trade from our own home. So we are just trading our own money. We individually, we don't have a lot of money. So we're just trading small funds. Right. So that's at an individual level. We have seen a rise in individual traders, especially over the past 10 to 15 years, especially because of technology and the ability to trading is no longer just, you need to, I think with technology, you can trade from literally anywhere. And also brokers have really brought down the barrier to entry by allowing small accounts to function. So globally, we have seen a huge rise in retail traders, right? Which is good for you and me, especially as we become traders. So we then, so it's also important to say which currencies are normally traded. So currencies that command lots of liquidity, which are used for international trade, are normally the currencies that we trade a lot. So number one, you obviously have got the US dollar. In the foreign currency market, the US dollar has got 42% market share. So you see, as you begin to build your trading strategy, that the USD is going to be, so the USD is going to be one of those currencies that you definitely have to, that you definitely trade, because it's very liquid and it's also in demand. Right, then followed by, after the US, you also see that the euro is the second currency, which will always be in your plan as well when you're trading. It has about 20% of the market share. So the greater part of Europe uses the euro. So it's also one of the biggest currencies, touted to probably overtake the dollar at some point. But it's a very political currency because it's used by many countries. Then you've got JPY, which is the Japanese yen, with 10% of the market. Japan is a heavy manufacturing company. So you see that this is one currency that's also very dominant in the trading space. Right, then you've got also the GBP, the Great British Pound, affected by Brexit of late, but I think now Brexit is a thing of the past, with 6% of the market share. That's another currency that is a big player. Then you've got the Australian dollar with 4% of the market, followed by the New Zealand dollar with 3% of the market. You've got your Canadian dollar with also 3% of the market. And then last but not least, you've got the Swiss francs, that's Switzerland, with 2% of the market share. So that's 2, 4, 6, 8. So those are 8 currencies which are really, so you find when you're trading, this is where you're likely to be trading in most instances in these currencies. Okay, they're currencies that you're not going to see here, which a lot of people have always asked me. Right, so and we'll talk about those later on. So one thing that I want to emphasize is when you are trading, essentially what you're doing is, unlike investing in shares, where you go and say I want to buy Econet shares, right? When you're trading, it's a bit different. You trade a currency against another, right? So you have to, so in that sense, you always trade currencies in pairs. So we talk about what we call currency pairs. So you're going to trade your currencies in what? In pairs, right? So in pairs, so we have got what we call major currency pairs because of their liquidity. These are out of these 8 currencies that we spoke about, with a pairing of the US dollar. So that becomes your major currency pairs. For example, you've got the Euro USD, right? The Euro USD, it's a major currency pair. Remember I said, if you take all those other 7 currencies, if you pair them with the USD, that's what gives you major currency pairs. So you've got Euro USD, you've got GBP USD, you've got OD USD, you've got USD CAD, USD JPY, until you've finished all the seven currencies. So this become your major currency pairs there. And followed by what we call minor currency pairs. So minor currency pairs are now the remaining 7 currencies paired against each other, excluding the US dollar. Remember, we said the pairing that has got the US dollar in it. It's called it will be called a major currency pair. So, for example, if the currency pair like CAD JPY, which is Canadian dollar versus the JPY, that becomes a minor currency pair. Your Euro CHF, your NZD OD, your GBP CAD, these are minor currency pairs. Now, what I want to emphasize is, especially when you're beginning as a trader, you probably find you probably stick more to major currency pairs because these are very liquid and normally are not very volatile, okay? As compared sometimes to minor currency pairs, which are not sometimes very difficult to trade. Then the last one is what we call exotic pairs. So exotic pairs brings in currencies now of other main, maybe your BRIC countries, your Brazil, your South Africa, and all. So any pairing that has got that is an exotic pair. For example, you've got the ZAR USD, which is the South African rand versus USD. You've got the USD versus the Hong Kong dollar. You've got the AUD versus the Mexican, I don't know whether it's Mexican pesos or something, right? So that would be your exotic, pairs. Now these ones, personally, I don't even touch them, largely because they're not very liquid, so they become very expensive to trade and can be very, very volatile. Okay, so mostly you're going to trade between your major currency pairs as well as your minor currency pairs. Okay. So now let's talk about if you've got any questions, you can still already put your questions in the chat box so that by the time I'm done with the presentation, we can attend to some of those questions. Okay. Right. So now that you've understood the different currency pairs that you're going to trade, let's talk about some of the Forex trading concepts, which are very important, especially if you're beginning as a new trader. The first one is your currency notation. Okay, so whenever you see a currency being quoted, right? So whenever you see the currency being quoted, it's going to be Euro USD, then 1.2025. The first currency which is quoted, we call it, in this case, the euro, we call it the base currency, okay? We call it the base currency, and it's normally 1. The second currency is what we call the quote currency, and that is so in this case, you're saying 1 euro will give you 1.2025 USD. So every time you see currency being quoted, Euro USD, the first currency is the base currency, and it's always 1. So what we are quoting is there, how much 1 euro, how many US dollars will 1 euro give you? So in this case, you already see that for 1 euro, I'm going to get 1.2025. So every time you see currency being quoted like this, you should be able to interpret what it sort of means, right? The next concept is then the concept of the ask, bid, and spread. So the concept of the ask, bid, and spread. Again, when you see currency being quoted as a development from here, is that you always see 2 rates, okay? You always see 2 rates. You've got, like in this case, Euro USD 1.2025, 1.2028. The first rate to be quoted is the ask rate. And the second one is the bid rate, which is the buying rate. The difference between these 2 currencies, in this case 0.003, it's what we call the spread. So you'll see when you start trading as well that there are some brokers that don't they say we don't charge any commission. So the way they make commission is by charging you the spread, which is the difference between those two currencies. So when we talk about sell and we talk about buy, we're normally talking about it from the perspective of the broker themselves. Okay, so that's what you're going to see. You don't have to claim it, but it's just that understanding that I'll always get 2 rates. Okay, always take the one that puts you at a disadvantage there. Now, one term that you're going to meet every time you're trading, and that becomes part of your trading language, is the term PIP. Okay, right. So Pips and Pipettes. So the language that you are going to see whenever you're trading is that, for example, someone will say, I've made 12 pips, I've made 13 pips, I've made 100, I've lost 10 pips. So one pip movement is 0.0001, okay, which is to the 4th decimal place. So when you talk about, so currency in the past, I'm going to talk about the changes now, but in the past, currency was always quoted to the 4th decimal place. Like, for example, you see GBP being 1.3033 to the 4th decimal place. So a movement in the 4th decimal place, one movement in the 4th decimal place is what we call a pip, okay? In this case, for example, currency moved, say, from 1.3033 to 1.3045. The difference here is 0.0012. Instead of saying we have a movement of 0.0012, you can just say we've got a movement of 12 pips, okay? So pips is going to be a term that you're going to be very familiar with. Then you have what they call, now until recently I said it was quoted to the 4th decimal place, but now it's quoted to the 5th decimal place, okay? So like you see, that's what you're now going to see on your trading platform. That is going to be quoted to the 6th decimal place. The 6th decimal place is 1/10 of a pip, or some call it a pipette, okay? So one way of putting it is 12.1 pips, which in other words, it's 121 pipettes, okay? That's one way. So always don't be confused. But normally the common language is still around pips, right? So there is a Google form that's been posted in the chat box, kindly asking if you guys can also complete that. I think that information will be very beneficial for us, okay? If you can complete the Google form that's been posted there. So essentially that's Peeps and that's Peeps and Pipettes, which is a very common language in trading, okay? The next one, which I like about trading and which is important for you to understand, is long and short. Right. So in trading, remember I said you're not buying the underlying asset. Your interest is in the movement. So if you expect a price to go up, what you're going to do is you're going to enter, which is you're going to buy, right? So every time you buy an asset, your expectation is that, for example, the price is going to go up. So every time you then have, so in this case, if you're expecting the price to go up, you enter, you buy, which means you buy low and you sell high. That's how you make a profit, which is what you normally do in the traditional sense. And that's what we call going long, okay? However, with trading, you can also go what we call short. So for example, if you expect the rate to go down, you can profit from the rate going down by going short. You're going to enter a sell and you exit by a buy, and then the difference becomes your what? The difference becomes your profit. So it's one of the major advantages of trading is that you're not just looking at assets going up, you can also make a profit by the price going down. What you need in your analysis is to be able to say, do I expect the price to go up or do I expect the price to what? To go down, okay? So in the sense that, for example, if you expect the price to go up, you go long, but if then that price goes down, that's how you make a loss. If you expect the price to go down, you go short, which is sell. If then the price goes up, you end up making a loss. So that's how, one thing that you need to understand. So it gives a lot of trading opportunities, like, for example, so even in times of crisis, even when the stocks are going down, people who trade stocks still make money, whereas investors lose. Even when the stocks go up, people who trade can still make money. Let me just draw you a graph. Normally, this is how, let's say, the price of a currency or the price of a stock moves, okay? Even if it's going up, it will have periods where it goes down. It goes up, it will have periods where it goes down. It goes up, it will have periods that are going down. So as a trader, what you're doing is you make money when the price is going up. That is the whole intention here. You also make money when the price moves down. That is the intention here. You also make money when the price goes up in this. So you're just entering and exiting, depending on your analysis. So you're not just profiting from the price going up, but even the down movement can actually be points of profit, okay? As long as your analysis is correct. So that's what your analysis is going to be, it's going to be about. The last one, which is important for you to understand, is leverage. We call it margin deposit, okay? Right, this one, it's always important to understand that 1 pip, we said 1 pip movement is the movement to the 4th decimal place, which is really 100th of a cent. So when you begin to look at it, it's not much. I mean, you need 10 pips for it to be a cent. You need 100 pips rather for it to be a cent. So how do you really make money in Forex trading? So one of the ways in which you really make money is through leverage, okay? Whenever you open an account with a broker, they'll indicate the amount of leverage that you want. For example, personally, I use a leverage of 100, but you'd find some brokers can give you a leverage of up to 3,000, okay? So what it means is if I've got 1,000 USD in my trading account, I can get 99,000 from the broker, 99,000 from the broker as leverage, allowing me to trade an account of 100K. That's what 1:100 comes. So in this case, I'm entering contracts using 100,000 because the broker has given me 99,000 to trade. So when you begin to look at 100,000, for example, this is what we call one lot. 1 pip movement, if I'm trading a $100,000 account, is actually $10, right? So what that means is already by making use of leverage, I can actually trade a much bigger account. So what the broker says is, so long as my losses do not exceed 1,000, if my losses exceed 1,000, you close my account off because the broker then doesn't want to expose himself. So you give you leverage to the extent that your losses will not exceed the amount that you have deposited, which we're calling margin deposit. So in this case, the more the leverage you get, the higher your ability to make profit. But also it comes on the downside that the higher the leverage you have, it also means you can also quickly make losses and burn out your entire capital, okay? Right, I'm really running out of time, so I just need to move a bit quickly there. Now, you'll then see that when you talk about trading, again, we talk about 2 types of strategies that people employ in their trading. You've got what we call a fundamental strategy as well as technical strategy. So when you're using fundamental analysis for most traders, is that they're going to use economic fundamentals, okay? So they're going to use economic fundamentals to determine what's going to happen to the currency. So they look at job data for that country, you look at GDP, you look at interest rates, you look at geopolitical events, you look at announcements. So for example, if the job data says the economy is creating more jobs, what it means is this currency can become stronger. So you expect the currency to move favorably, okay? But if the economy is not creating enough jobs, that can weaken a currency. So that's what fundamentals do. The bulk of traders, or 99% of traders, are not fundamental strategy because it's very complicated. Most people are technical traders. They use price patterns, and you're going to look at. I'm just going to demonstrate a little bit, just to help some people here. So you use your price chart, you analyze movement, you analyze patterns as a way of determining how you're going to place, how you're going to put the trades. And you'd find even in our trading platforms, we've got lots of technical indicators that can help you in that analysis. You also have got, I think, one of the most common ones are Japanese candlesticks. I'm going to show you how people use them. Right. So that's in essence, that's an overview of trading Forex. So one of the things that you need for you to be able to trade Forex is you need to go through a broker. Okay, so whenever you're trading Forex, you'll need to go through a broker. There are many, unfortunately, in Zim at the moment, there is no broker who is based in Zimbabwe. So you're going to make use of brokers who are outside Zim. But that's not a big problem because you never really walk into a broker's office. You always relate to the broker online. So it doesn't matter whether we don't have a broker in Zim. So the broker, what the broker does is, remember, the broker is the one that gives you access to the Forex market. So you don't trade directly, but you trade via broker. So the broker is going to give you a trading platform, which you then use to place your trades. And the broker is just using that platform to remit your trades. And normally, brokers are not expected to take any risk. All they want to correct is commission. Ideally, that's the traditional role of a broker, okay? So they'll give you a trading platform. Most common platforms that people use these days, you've got what we call MetaTrader 4, which is MT4, and then you've got MT5. Then there are other platforms like your trading views. If they are traders here, some of you are familiar with them. I'm just going to show you just now how in MT5 platforms looks like. Then, so I was talking about limitations for Zim. So for Zim, you find, because there's no broker who is based in Zim, and sometimes it creates a bit of a problem, but also because Zimbabwe are under sanctions. So you'd find that American brokers from some parts of Europe, brokers in Australia, some of them don't even open Zimbabwean accounts, which puts you at a disadvantage. I think when you look at most people use brokers who operate either from Cyprus, other Eastern European countries, as well as Mauritius. This is some of the brokers that a lot of people use. So one of the things that's important to note is that sort of limits you, because at the end of the day, you want to deal with the properly regulated broker. If anything happens, you want to be able to say, who do I approach? For example, if for some reason the broker closes their website and I've got my money there, you want to be able to say, what is my recourse? So that's the biggest disadvantage of using some of these unregulated brokers coming from those other countries, because the regulation there is very low. So that's one of the limitations that you are going to see when you are dealing with a broker from a Zimbabwean perspective. Again, most brokers as well, they prefer to use more online wallets. Some of you are familiar with Skrill, with Neteller. Those do not work in Zim. They don't open Zimbabwean accounts. So it sort of like puts you at a disadvantage. But there's always a way around these things, okay? So one of the things that we have done from my company, from Elles, is that we've got an affiliate relationship with a broker called Quick Trade. Because we've got a relationship with them. For me, people have been asking for recommendations. This is a good broker. They operate, their head office in South Africa, which is very close, as well as they operate from Botswana as well. So they are regulated by the as a financial service provider. So that's one broker that you can use. One of the advantages of Quick Trade is they don't use online wallets, so they transfer direct to your account if you need your money. So if you've got, even if you've got a Nostro account, they can actually transfer money into that account. Right. If you complete the Google survey and you leave your details, I will be able to send you a link that you can use to open an account with that broker. Right. I just want to quickly just do a demonstration in the remaining few minutes of a trading platform called MT5. So I'm just going to share my MT5 screen just for you guys to just have an appreciation of what practical trading entails. Right. So this is a Quick Trade platform. I just used a demo account here. Right, so I just used a broker account. So this is the platform. Like I said, when you enter, you open an account with the broker, they'll give you a link. You're able to download this platform onto your laptop. You can even download it onto your phone. I think there are platforms for phones as well, for particularly Android phones, which are easy. Sometimes with Apple products, it's always a challenge. Right, so that's a typical platform. So when you open it, that's what you're going to see. Let me just start from here. So I go on File, and I say New Chart, and I want to see a Euro USD. Remember I was talking about that you trade in currency pairs. So when I open, this is what I see. This is how from F5, that's how the chart is going to come. Now, just to show you, I could change the way I want. Let me start with the easier one. Right, let me just start with the easier one. Right, let me just show you. Right, so some of you are familiar with the line graph. Let me start with the line graph, which is easy to interpret. So at the bottom is the time, and then this is the rate. So you can actually see over over a period of time, you can actually see how the rate was moving, okay, through a line graph, right? Like I said, you can still do a bar, or you can do, these are called Japanese candlesticks, okay? And you'd find that when you become a trader, you probably prefer this view more than the line graph, because this view tells you more information about that. I'm just going to change something just to illustrate something here. I'm just changing the color of my bars just for you guys to appreciate when I said candlesticks works better sometimes, right? So our bar down, I want it to be red. Our bull, I want it to be green, and our bear, I want it to be red. Okay, right. So I've just changed the way my graph looks. So what you can actually see here is every time you're seeing a red, that is the price being down. Every time you're seeing a green, that is the price being up. So you can actually make a sense in terms of what's happening in the market. So for example, when you look at this particular period here, you can actually say that the price is not decided in terms of where it wants to go. You see a green, you see a red, you see a green, you see a red. The moment I'm doing that, it's actually technical analysis that I'm doing. So it sort of helps me to do that. What you also see is, you see this line, these lines here, they're called wicks. So what this bar tells you is, at the bottom of the wick, this is the lowest price that the price reached in that session. And at the top of the wick, this is the highest price that the price reached. And then you've got the opening price and the closing price. So just one bar will tell you more information than when it was a line graph, right? Now, I was telling you about the, right, earlier I was talking about the instruments that you can trade on this platform, right? The instruments that you can trade on this platform. So if I say open new chart, so you can actually see if I open a new chart, I've got Forex. Forex has got, I think, around 29 pairs, which are major and minor currency pairs. I'm not even counting exotic pairs. So these are the instruments that you can actually, then here it says CFDs, which are contracts for difference. So you've got commodities. You can trade silver, platinum, gold, palladium, Brent. You can also trade international indices. You've got S&P 500, FTSE 100, Dow Jones, NASDAQ. You can also trade US equities and CFDs. So these are now your Google, your Amazon, your different companies on the US stock exchange. So like I was saying earlier, that the trading market is much bigger than Forex. So you see that with this particular platform, you can actually trade all these instruments. So they're quite endless. But what I've always emphasized is you can't be trading everything. You need to be a master of one in terms of you have a specialty. Which market do you want to trade? Personally, I specialize in Forex. Okay, so what it means is I've learned and understood Forex, and I keep to that market. If you want to trade stocks, you can still trade stocks, but you need to spend more time understanding what drives the stocks. Right, just quickly, how do I place a trade? Just to show you, this is a demo account, so I can easily place a trade. Right, so here you can actually see on this graph that you've got these two prices. So this is your sell price, and the blue one is your buy price. Like I said, you always have got these two prices. Here, the currency that I want to trade is your Euro USD. I indicate the volume. Normally, it's in lots that you want to trade. I can say I want to trade 3 lots there, which is equivalent to 300,000 euro. Right. Right. Let me trade. Yeah, 3 lots. I can do 3 lots. You can also indicate stop loss. In other words, the price that you want, the minimum price that you're willing to keep the trade, or you can indicate the level you want to take profit. So if my expectation is that I'm looking and I'm thinking the price is still going down, I can enter this trade by sell, or you can enter this trade by market. So sell if I expect the price to go down, and buy if I expect the price to go up. The sell trade here. Right, so you see it took literally a few seconds. This was probably a bit longer than it normally does, but the order has already been met, okay? So in this case, I can already see this is my profit or loss. The reason why I always start in a loss, it represents the spread that I was talking about. Okay, so this is a trade that's already ongoing, and you can actually see here that's where the price is moving. The last thing that I want to demonstrate is when you're trading Forex, you need to determine what kind of a trader you want to be. You see here, you choose the time frame you want to trade. In this case, I am on 1 hour. So I'm trading by the hour. So each bar that you see here represents 1 hour, okay? I can decide I want to trade a 4-hour time frame, okay? So if I'm trading 4-hour time frames, what you can actually see here is that each bar now represents a 4-hour period, okay? So the movement is not gonna be as fast as compared to a 1-hour session. I can even decide I want to do 1-day session. So what it means is it takes a whole day to do 1 bar, okay, because I'm trading 1-day time frames. I can do 1 week, I can even do a 1 month, depending on your strategy. But some of you are familiar with scalpers will trade 1 minute or 5 minutes charts, okay? So if you're a scalper, you're trading 5-minute charts. So in the process is every 5 minutes a new bar comes. So the trading becomes very fast, or you can even do 1 minute. So depending on the type of trader that you want to become, you can choose the time frame that goes for you. So ladies and gentlemen, even as I just finished this demonstration, trading is about determining the price is here right now, 1.93. It's determining what I expect. Do I expect the price to go up or do I expect the price to go down? If I expect the price to go up, I'm going to enter a buy. If I expect the price to go down, I'm going to enter a sell. That's what trading is about. Right. So that's essentially what you're, so all the technical analysis that you're going to do, fundamental analysis, is to be able to predict the future movement of this particular price. If we are right, we make money. If we are wrong, we lose money. So that's what trading essentially is going to be largely about. Right, so I'm going to stop sharing now and then just open up for questions. So please feel free to raise your hand if you want to ask a question. So I'm just going to check the chat box. Right. I know I was going too fast. Some people might have struggled to understand what we were talking about. Right, so someone says in the chat box, will you facilitate us to open a broker account and a local account which we can send money to them, to the broker? So in terms of depositing money to a broker, that is the easiest process. If you go to Bank ABC right now, in 5 minutes, you'll have a Visa card. So you deposit your money in your Visa card and the broker will accept money through the Visa card. In fact, Bank ABC have got what they actually call dial a visa. They can actually deliver a Visa card to your doorstep, okay? So that's how easy it is to deposit money to a broker. Like I said, I'll send through the link to those who've signed up on a Google form that you can use to open an account with the broker. But in terms of depositing, you're gonna use your Visa card. Now, in terms of withdrawing money, your capital can be withdrawn via the same Visa card, but profits, you need to use a normal bank account to withdraw your profit. That's why I was saying you can provide your Nostro account details here, or in any other country, they'll be able to send your money. Okay. Right. Someone is saying, please come again. What is a PEEP? So when you're talking about a PEEP movement, they're saying it's one movement to the 4th decimal place of a currency. So when you're coming to Forex trading, we'll always be talking about pips. So when I traded today, I lost 30 pips. So when someone says I lost 30 pips, you should be able to interpret what it means. It means I lost 0.030, right? So that's sort of the language that you use in foreign currency and foreign currency trading. Look, as you guys become traders and more traders, you begin to understand this language better. Now, one thing that I know is that there's no way we were going to do justice to everything. So I want to encourage you to take this action so that we spend more time practically, theoretically dealing with these issues. We've got a class that's starting on Monday, which is next week, Monday, which is 22 March. So we're going to be running it on Zoom to accommodate those who go to work. It's going to be from 6:30 to 7:30 in the evening. So it's 4 days, 6:30 to 7:30. It's going for $40 RTGS. But if you register by end of day today, you can pay, you can only pay how much? It becomes $30 or 3,600. So Eva is going to post on the chat box the registration form that you can actually use the registration form that you can actually use in order to register for this particular course. What do you need for this course? You need internet access, because it's going to be via Zoom, but also because we're going to be doing practicals. You also need a laptop or a smartphone, so that if I say go and download the MT5 platform, you can actually do it on your laptop or smartphone. And also, obviously, availability becomes very, very important during the course. Right, let me just check. Yes, so Eva has posted the full information brochure in the chat box. She's also posted the Forex registration form. And then Freedom says, so is 4 days training enough to get us started, or is just introductory? So the 4 days will leave you being able to trade. Now, when I say being able to trade, you'd find when you have covered the theoretical aspects, you need to appreciate the practical aspect. So one of the biggest advantages of most brokers, and we're talking about quick trade just now, one of the biggest advantages that you're going to get is you get a demo platform, like the platform I was showing you. It wasn't, when I was putting the trade, it wasn't a real live trade. It was a demo. It was a demo platform, right? So after the 4 days, what I expect is everyone should start doing a demo account. So you start, before you start risk, because guys, trading is risky. Before you even start risking real money, you need to have practiced your skill, how you do it, the things that we talk about on the demo platform. When you're now confident that, you know what, I think I know what I'm doing, that's when you now start to think about depositing money to the broker. So when so one of the things that I want to emphasize now, when you open an account to the broker, don't worry about depositing money. Like I said, you're not gonna start trading next week. What you want, number one, is to start, with a demo platform where you've got access to the real market, but using dummy money. You trade there. I think we have a community where we begin to share information and what you're finding out. And you practice until you're confident in terms of the strategy that you're using. At that point, you then decide to actually deposit real money and start trading. Right? What is the minimum amount that you need to start trading? Right. I need to confirm with should be around $20, but I'll need to confirm that. So it should be around $20. And after you've done your demo trading, start with an account which is $20. Don't start by depositing 500. Don't start by depositing 1,000. Because I'll tell you, you want to start by, when you're doing demo, you're not risking real money, so there are no emotions involved. But the moment you put real money in, because now you're dealing with actual money and actual losses, emotions will always come into play. So if you start with low amounts of money and you gradually increase them, that will help you deal with the emotional, managing the emotional aspect of things. So to start trading, again, for me, start with $20, increase it to $50. Don't just start by borrowing $100 or borrowing $1,000 and thinking that, look, I'll be able to double this money. It's not going to happen. You need to make sure that you're building a strategy. When you're fairly confident, then you can actually then increase your account in that sort of sense. Okay. Right, guys. So what I want to encourage you, even as we come towards the end of our presentation, is that, look, if you're serious about trading, please take advantage of this course. It's reasonably priced. It's not much. You can register, and next week we're going to be getting deeper. I was rushing, but at that time we've got more time to really make sure that you understand the whole process step by step. And then after that, look, the conversations become different. Okay. Right. Again, Eva is saying to those who just joined us, please, if you go to the chat box, you see also a link for the Google form as well as the registration the registration forms. Okay, right. So that's essentially the presentation that we had for you today. Thank you very much for making time and being part of this conversation. I hope you may not have gotten everything, but I believe that you've gotten one or two. And my intention was to make sure that you've got appetite to trade. I hope I've been able to do that, and you guys will start trading.